Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features a conversation with Anthony Capizzano, the SVP of Consumer Direct Lending at Axos Bank. Anthony and I talk about a lot of things, but really their unique perspective as a bank that's always been no branch and how they think about bringing high-touch personal experience into an interaction that's not in person. Particularly how you get to helping people self-serve quickly when that's appropriate and how you get them to a human quickly with the right information when that's appropriate. Secondly, we talk about a couple of new product areas they're exploring, including a kind of a new flavor of securities-backed line of credits and what the impacts of the shift to EVs might be in auto dealerships and sales, as well as what that means for lenders. And finally, we talk about their approach to technology with short sprints, rapid iteration, really focused on solving consumer pain points and how you don't get distracted with what your competitors may be doing, but really focus on solving your customers' needs. So a lot of great insights in here, and I really hope you enjoy the conversation. Anthony, thanks so much for joining the podcast today. I really appreciate your making the time.
Thank you. Thanks for having me.
Yeah, my pleasure. When we were talking earlier, you said something that kind of took me by surprise. I've talked to a lot of banks about how they're melding their branch approach and a digital, and you guys are a branchless bank, as I understand it. Talk to me a little bit about. You've been where everybody else is going, or at least have been thinking about the challenge of customer relationships without physical presence for longer than I think many banks have. How do you think about what you guys have invested in terms of maintaining that high quality relationship, high touch experience where appropriate in a world where you don't have, people in a physical place that are meeting? And I think the way a lot of banks have typically managed that.
Yeah, look, that's a great question. That's one that we've been very focused on for a long time because, look, we were a digital bank before it was popular. I like to say we were on the dance floor by ourselves dancing, and then now everyone wants to join us, which is great. But with that comes new challenges. And one of those challenges is the one you pointed out, which is, how do you create that human touch without having the physical human touch, right?
Yeah.
This has been accelerated, as we know, due to COVID. And I think people are trying new things, and they're trying and I think that's the right approach. But for us, it's kind of an old hat a little bit. And we've been practicing that for the last 20 years. And so we have a wide variety of ways. Of course, you have to have the digital capabilities to enable what I call the soft touch points and education points so that customers can find information easily. But you're still going to
soft touch for me before you get
Sure. So soft touches are where they can interact with your software in a way where it's easy to find the answers that they're looking for. So it's not just think about search functionality. Like if you ever built search functionality, it's really hard. It's not easy. And so search functionality to find exactly what the customer's looking for when there may not be as articulate as they want or need to be to find the answers, right? Sometimes we just don't know. So that's more of a soft touch. How do you make it easy for a consumer to find the information very quickly?
Self-serve, I'm coming in, I'm browsing, searching, I want to find a little something. Okay, got it. Thank you. I want to make sure I understand the terms.
Yeah, and then so you have that, and you need to provide those little answers very quickly, right? But there's always this human element, right? So if you recall, there's a lot of credit card companies, a lot of banks that went IVR, and they went into a virtual reality where, and then they realized that they were losing consumers, and consumers were running back to smaller banks because they could have a live human. And so what you saw is that these larger institutions were saying, okay, how do we fix this? How do we get the right touch point, but while maintaining our efficiencies, so we're not just staffing up a whole lot of people like we did, because literally we just ramped down in people, right? By providing this, we invest in this other expensive technology. But this is how technology works. You implement something and then you find out it's not as fulfilling to the consumer as you wish. That's why getting the voice of the customer is critical for whatever you implement in technology.
Well, I think the other part of that is adaptability, right? Because what's the old saying? Like no battle plan survives first contact with him. However you think your customer is going to interact with your brilliant thing,
Yeah.
it's going to be different. You got to be prepared to adjust. The IVR is a fascinating example. So sorry, I didn't mean to interrupt, but
No, no,
I think it's a great point.
that's a great point. So, um, what we did was we were very intentional on identifying the purpose of these phone calls where they
Mhm.
really needed someone, both on comments on our web presence and even through complaints, right? Complaints are very important for us. We go through those on a monthly basis and say, how do
Yeah.
we make ourselves better? And does this need a human touch point, right? And we've built entire teams that weren't contact centers so much. They were more products, we call them product specialists,
Mm.
where they had enough knowledge where they could provide, a more detailed answer.
Hmm.
And that seemed really to work well with us. So
Interesting.
identifying certain questions and certain subjects where a human interaction was kind of required, but also giving the option always to consumer just to get through to someone because some people just don't like talking to a computer, right?
Yeah, your point about IVR is really fascinating to me. The kind of we tried to automate so much of that stuff, and I'm curious how you think about. You've identified the topics that someone might want a human touch for, and I certainly have heard this in my conversation with banks. They want advice. They want to understand what are my different options. What are these what are my different down payments and non and point. Like how do I think about terms and different kinds of options? But how do you identify in the moment whether someone is looking for that kind of touch or looking for a self? Because it feels like when somebody calls in, right? How do you figure out if this is a high touch required moment or if this is a soft touch required moment? Because that feels like the crux of it. You want to get them to a human quickly if it's a human needed, and not if it's not, so you're not wasting a ton of hours. But how do you tell? How do you make that distinction?
Yeah, so that's a great point. So um, it's a process. It's a journey, first of all, and
Mm.
it's not like a one size fits all. Because we're a completely digital bank, we have a different dynamic than traditional banks who have branches.
Hmm.
And so with us, we had to go on this journey and discover those touch points. And when we had a default, we actually defaulted to talking to human.
Talk to.
That and we were very specific on our product specialists based on the product.
Mm.
So that is a whole different thing because it takes a little bit larger investment because it behooves you to generalize, right, from an efficiency standpoint.
Hmm.
We did not. We got very specific.
Interesting.
So I have a team specifically for one loan. I have another team for specifically another loan, right, depending on the
Hmm.
volume and whatnot. Um, Another thing we did is we combined some lower volume and we made them on a pod structure
Okay.
so that means they all are cross-trained with each other for those two different products and they're like products, right? So
Hmm.
because it's so specific and the product specialist does that every single day, they become a lot more honed in their answers as well.
Yeah. How do you think about the layer of helping a customer choose between products? Let's just say like a HELOC and a personal loan, because the specialization is really valuable when you want really good answers on one thing. But I think there's often this layer above for many consumers, which is like, which product is the fit for my need, right?
hmm
And how do you think about solving that layer of the human touch interaction when you have a specialized workforce?
Look, that's a great question. I'd say that you have to be careful about giving advice and be very firm on your advice. You want to give options
Mm.
and allow the customer and voice that in a way like, listen, if you choose this option, here's your benefits, right?
Hmm.
Here's some drawbacks. If you choose this other option, here's some benefits and your drawbacks. For your needs, um, you know, you should probably look at both
Hmm.
and decide, right? But I can't tell you one or the other. I won't put my foot down on one or the other
Yeah, yeah.
because I don't see the full picture, right? This is a one touch point phone call. Maybe it's two, um, but I know I don't have all the information,
Yeah, yeah.
right?
Interesting.
So
And who in the specialist world has that kind of conversation? Or is everybody informed enough about the different products to have that level of conversation before you go to a specialist? I'm just kind of curious.
so no, so you go right to our product specialist
Mm.
when you call in, right? It's based in, and it's diverted there. So you go right to I mean, they may think it's a customer service person, but they're actually getting a product
Product
specialist.
specialist.
And so that product specialist knows exactly, the benefits, the pros and
Mhm.
cons. Now, if they want to talk about a HELOC, for example, what we do in those cases, we give a warm transfer over to HELOC,
Hmm.
and we have them talk to them, and do it that way, because that's a very different product than, let's say, an unsecured loan, right?
Totally.
But one thing we also do is we send up an email saying, listen, if we didn't answer all your calls, click on this, and you can call us right back or chat. So you make it a lot easier to continue the conversation as well.
Yeah. That's a fascinating structure, very different than what I've heard many places. So it should be insightful for the listeners. You're talking about product specialists. One of the things I wanted to talk to you about was like new products or areas in kind of consumer offerings where you're seeing new opportunities or new needs or demands from the consumer market. Are there things you're seeing either that you're pushing that you think are valuable to consumers that they're not asking for, or that consumers are coming saying, "Hey, I want something different"? Kind of new product areas that you're investing in.
Yeah, so we are actually investing in quite a few, but one that is really interesting to me is this an S block loan. So it's securities based line of credit.
All right.
And basically what this is if you have a portfolio, an investment, a
Mm-hmm.
small portfolio, you can have a secured loan based on the value of that portfolio.
Mm-hmm.
So there's a lot of moving parts to it. But if you go to most banks offer this, right? That offer
Typically, the
investment.
higher net worth. I mean, somebody's got an IRA, a 401k, a bunch of money in there, and they want a cheap line of credit, right? I think of that as a
Yeah,
more well-to-do client need where I'm leveraging my investment portfolio to get, as opposed to a HELOC, you've got my 401k, just give me a securities backed line of
right,
credit, like that kind of
right.
thing. That's typically how I think of it, but you guys are viewing it a little differently than the high net worth play.
Yeah, we are. So you're right. It was pretty exclusive. It is very what we call cheap money. It's lower, very low
Yep.
interest rate money. But typically the minimum amount of finance is like $250,000, and the
Mm.
securities that you have to secure above that is far greater than that. So
Yep.
it doesn't really make sense for the average Joe like you and I.
Yep.
So what 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 we decide to build is something a little bit different. Um, we're building a product that is more attainable for someone who has maybe a smaller investment. You know, maybe they have, they need $10,000. And most of our competitors aren't doing that. And
Hmm.
what that does is that enables the average everyday person to get access to inexpensive money, you know,
Hmm.
that they can go buy something with that. So think of it like an unsecured loan, but secured that you can do anything you want with it. But it doesn't have to be $250,000. You don't have to have that. You could have, 10,000, 20,000, 30,000. You want to go buy a car, you can do it that way, right?
Hmm.
Sometimes it's a little bit more beneficial. Of course, we always advise people, to work with their accountant to get
Yeah.
the,
Yeah.
the proper advice that they want. But look, it is going to be a unique aspect that I think most consumers, uh, it's the 80/20 rule. We're going to hit 80% of our consumers versus what that product is designed to do is it's the opposite, right?
20%. Are there different kinds of assets that you find as you move down there that you're securing against? Is it the 401k, at the big firm? Is it what I think of as the typical, like it's my investment portfolio, maybe my 401k. What kind of assets do you see or now are they different for, a smaller dollar, more typical average Joe, S block versus the kind of more historically traditional high net worth version?
Yeah, so just a little education on that. So the volatility of the stock really matters, right? So
Mm.
the advance a bank will give you, or every bank is a little
Yeah.
bit different, and so what they'll advance on that specific stock is going to be changed. It changes, and it changes daily, right? Because the markets move, and there is something
Sure.
called a margin call if you go below what they're willing to lend, because you
Yeah.
have a deep,
Good.
right? So you'll have to make up or liquidate some of the stock, but that's very rare that happens. That's not beneficial for the consumer or for us. So we try to put in a few safeguards. But one thing that's super interesting that's occurring right now is Cryptocurrency, people want to secure against cryptocurrency. Now that is a very volatile stock. And so,
Indeed.
I mean, it ebbs and flows. I mean, look at Bitcoin. It was in the last year, it went from 11,000, now it's like 62,000. So
That's
it
big.
is very volatile, right? And so how, as a bank, do you enable consumers? It's a very interesting question.
Absolutely.
To lend off of this as a secured asset when it's so volatile. And that's something we're exploring right now,
Mm,
and we plan on doing. But it is a lot different than traditional stocks.
it is. Are you looking at, I know not so much in Bitcoin, but in things like Ethereum and
Yeah.
Solana and others, there are smart contracts where you can actually require liquidation at certain price things through the contract. Are you looking at any of those kind of automated enforcement mechanisms for things like liquidity? 'Cause it's a really interesting idea that you can actually, into the borrowing contract, have liquidity enforcement options and things like that that would be have to be manual or done some other way in a traditional world. So it's a really fascinating space to me what you can do in a blockchain that has some of the smart contract elements.
Yeah, so we have those, right? And but the idea is to prevent or limit that from happening because that's
Yeah,
no
yeah,
one
yeah.
likes that experience, right? So,
No, but when it goes
um,
from 62 to 11, like
right,
sometimes it's
these
hard to
things
figure out what
happen.
you're gonna, it's gonna be hard depending on what your
Exactly,
leverage was. That
exactly.
certainly is possible.
What I think you'll see is that as banks get into this space and as some coins stabilize, some coins will qualify and some coins won't.
Mm. Yep.
Um, and the ones that do qualify, I'm suspecting that they're going to have a very low advance rate just to dip their toe in.
Get started,
And
not get too much leverage into it.
yeah, and then and the biggest part of that is having banks learn how to ride the wave, right?
Yep.
So really that's what it is. It's hey, don't freak out right now. We know it dropped, 30% in the last, 3 months, but it'll recover. You just got to hold out. And that's untypical because it could be 4 months, it could be
Yep.
2 days. So you got to learn how to ride the wave.
Interesting. Now, while we're on the topic of new products, I wanted to ask about another product I think is disrupting a market and how that impacts financials, which is electric vehicles. So we talked about this a little bit, but what do you think? You were giving me some thoughts on how electric vehicles changes the structures for dealers and financing of automobiles. And it's fascinating because we see so many manufacturers at least announcing that they're on the path to pretty rapid electrification of their product lines.
Yeah.
How do you think that? I mean, if Bitcoin is shifting the currency market, EVs are certainly shifting the automotive market. And I'm curious what you think the impacts of that are on kind of maybe dealers on one level, but importantly on the kind of lenders and the way they work with automobile financing and purchasing as it exists today.
Yeah, that's an interesting topic. I think we can talk about this all day, but
Might be a whole
you know,
episode, but we'll have to do the
right.
slightly abbreviated version.
What Tesla's done is, and it's been led by Tesla, but there are many other players out there, by the way. And most banks will finance some EV vehicles, but they won't finance all EV vehicles because they're kind of unproven and some are
Mhm.
newer than others. So the risk is higher on those. We're actually a lot more open than that, but because we think the technology is very sound,
Mm.
and it's been around for quite a while. However, what Tesla did is they got the early adopters on, right? And now we're in the mid adopters stage.
Yep.
And what you'll find typically is that the late adopters come at a gradual pace as well. I think that's going to be more of a cliff. And we're on the apex of that mountain. And what I see is that downward trajectory is going to go very quickly.
You're seeing
And
a pretty rapid shift
it's
here.
going to be very rapid. It's going to be very rapid, and especially when you have Ford and GM and major worldwide car makers coming back saying we're going to majority of our inventory is going to be EV
The question is
by
infrastructure for
2025.
charging and things like that. I mean, it's a flywheel, right? Like more people have cars, you build more infrastructure. The infrastructure supports. It makes it easier to take a road trip in an EV, and the cycle goes on and on.
Yeah, and infrastructure's been being implemented for the last 10 years. If you look around, if you don't have an EV vehicle, look around. If you look at an apartment complex, good chance they have one. If you look at your garage at work, good chance they have some. Go to a mall now, good. IKEA has them, right? So, like, their infrastructure's there. for the most part. Do we need more? Absolutely, to have worldwide adoption. But it's there. It's good enough right now for that rapid advancement to happen. And what we're going to see here is as these manufacturers like Ford and GM, as they become fully sort of EV, which
Hmm.
are very short, 2025, they're going to have majority, right?
That's what they say.
It's going to be interesting about how the dealership is going to shift. Dealerships had to shift their way they made money in the past and how they survived. This is going to be another shift, but I think it's catching people off guard a little bit. I think you need years to change your business model.
Hmm.
You can't do it in a year or two. And I don't know if everyone's seeing how quickly this is going to happen, especially with the dealership standpoint. These are small businesses, by the way.
Yeah.
We think of dealerships as large business. They're really not. They're really just mom and pop, for the
Yeah.
most part, small businesses, and they can be disrupted very easily. And we've seen that when we had the recession and we lost almost, one third of our dealership population. So they can be frustrated, disrupted easily. And,
Hmm.
and we it's going to be interesting to watch because EV vehicles, a lot of the profit center for dealerships are on the repairs,
On
right?
the service.
On the
Yeah.
servicing, So EV vehicles don't have that much servicing. Do they have some? Sure, but it's at a lot lower clip, right? You're not replacing brakes. You're not doing oil changes, right? These are what we call lead-ins, and your lead-ins lead to more things that you can help fix that vehicle, make it more
Yep.
comfortable for the consumer. Not many of those for an EV. Now, there may be upgrades, right? Your price per fix or per repair or
Higher.
PO may be higher, but it's not going to outrun all those little ones, right? So that's literally a survival mechanism. In a recession, you see the dealerships that survived are the ones who had a very large absorption rate, anything north of 70%, which is
Hmm.
absorption equals the money you make in your servicing pays for the entire cost of the dealership. So that absorption rate is very critical. It's being interesting to see how they do that.
What do you think they do? I mean, if you were a dealer, what would your advice be on how you deal with, a future where, maybe your servicing revenue is going to be lower? How does a dealer like respond to that? And then how does, I guess for this audience, how does a lender respond to what the dealers are going to have to do to be a part of the solution for those dealers they partner with, in terms of how they
Hmm.
continue to make money in a world where that kind of absorption rate may be lower and the servicing revenue per vehicle may just be maybe lower over time? Because just like I bought a Tesla Model 3 and like I don't even touch the brakes, to be frank. Like it
Hmm.
brakes for itself. I don't think I've ever, I can't imagine how long it'll take for my brake pads to wear out for the 3 times a month I use the brakes, and there's no oil. And like I've never taken it in for service. I've never thought about it because it's never had an issue.
Yeah.
So that certainly feels like a future that's coming that's disruptive to that business model. So I'm curious, what if you were giving advice to a dealership and then to lenders who work with dealerships, what would that advice be?
So it's going to put pressure on the other profit channels that they have, right? They have the sale of the vehicle, they have back end products.
Mm-hmm.
Dealerships make on the front, what we call the front side of the business, selling the vehicle, most of their money on the back side,
Mm-hmm.
right? It's the relationship with the bank, and it's the back end products they sell to the consumer.
Mm-hmm.
Well, the consumer's going to buy less back end products because guess why? They don't need it repaired as often. So that's going to put more pressure on the lender and the other partners like the manufacturer itself to build in additional costs, revenue, or
Mm-hmm.
profit centers for the dealership. So maybe there's more holdback that the manufacturer will allow. Um, maybe because it's too transparent with sales prices today and invoice prices. So uh, they have to build it in the holdback, not so much in the profit margin between invoice and what they sell it for. Or dealerships have to shift to more of that. If you remember the Saturn model, or the CarMax model, the price is what the price is,
Yep.
like it or leave it. But you would have to have an entire shift of our culture in the United States on how we buy vehicles
Mm.
and not wanting to negotiate, right? We learned that the culture doesn't really like that. They like to negotiate. They may hate the experience, but they want a better deal. They want to feel like they got a better
I feel like I
deal.
got something out of the deal. Like I got my dent in the pricing. I did my job.
Exactly, exactly. So uh, I don't think that's going to shift anytime soon. So there's going to be pressure on these other profit channels for a dealership to make it up, including all of ours as partners with them.
Mm-hmm. Well, and one last area I wanted to dig in with you. I think we could keep talking about this one forever.
Mm-hmm.
But and it's kind of related to the sense of like how quickly can you shift your business model or your technology infrastructure. We talked about kind of the challenge of upgrading systems and kind of how do you get to that digital world. I wanted you to kind of share your thoughts on that because I thought it was a really interesting topic that's I think on the minds of every banker I talk to as they're looking at very old systems, needing to upgrade maybe everything, and how do I think about
Yeah,
how I get to what I want my future state to be?
yeah. Look, uh, from my perspective, I would say that most lenders or most of us are dealing with antiquated systems.
Mm-hmm.
And so what happens is, even if you got systems, 6, 7 years ago, that's still antiquated now, right? Because technology moves so quickly. So even if you have very old systems, I was at a previous company that it was very, very old systems, and 30 years old. And
Mm-hmm.
what I really learned there, what worked after a lot of trial and error, is that big bang releases, they have a lot of issues, and they're very, and they have, and consumers are affected typically out of these things.
Mm-hmm.
And so what I've decided to really move towards, and what seemed to work, was that is to catch the vision of where we want to go, right? And that vision may change, by the way, through times.
Mm-hmm.
So cast the vision, and then you chip away at that vision with value adds to the consumer. So don't look at, people, what happens is called scope creep. So they look at, hey, we want to do, we want chat capability. Okay, you want chat capability. Um, yeah, but in order to have that, we have to have this whole new system. Well, do you? Is there a way we could buy it off the shelf? And
Mm-hmm.
like, you got to look at your different options, or maybe that chat feature specifically, is that answering everything that you wanted? Because maybe there's a portion of that chat that that ends up being the majority of the value add for the consumer.
Mm-hmm.
Can you uncouple those things, right? And deliver the value add. So be more interested in delivering the value in small pieces than doing it in big bangs. Big bangs are very expensive, they're very long, and they tend not to have, you tend to make compromises along the way. And that when you get to the end, you have a mediocre result.
That's interesting.
But
Yeah.
if you chip away at it with these little value adds, you're adding value to your consumer and you're building toward their vision. Don't race against the clock. There's no clock.
Yeah, well, I think you're right too, because as you do big bangs, scope creep is almost inherent in that because it's like, well, if it's a 2-year project, I know if I don't get it in this one, it's 2, 3, 4 more years before I
Right.
get another shot at
That's
whatever it
right.
is that I want. And so, of course, the natural inclination for the organization is to shove as many things into your big bang as you can, and that just doesn't it doesn't ultimately work well versus the kind of I think we at Upstart always think about what's the smallest thing we can do that gives us the most learning and the most value for the consumer, right? And if you
Yeah.
optimize around value add and or learning, to your point
Hmm.
about the chatbot, like what are they really going to use it for? I know people talk about it, but like what's the real value? And you
Hmm.
try and solve the whole thing up front. It's hard. If you go, let's launch the little thing and see if it works, and how do we iterate from there? I feel like you get to the right place more quickly, frankly, than you do trying to get it all out the door at once.
Yeah. So that we have something similar. It's called shortest weighted value add. So we look at the value add and we say the level of effort and
Yep.
how quickly can we deliver that right to the consumer. And before you have to define the value add, get the voice of the customer, the whole bit, right? There is some due diligence there, but
Yeah.
assuming that you know it, that's how we look at it. And so our conversations isn't about the new and shiny thing. It's more about, hey, if something new comes in, does this add more value than this other thing that we're doing,
Yeah. Yeah.
right? So we're looking to add value in max like 4 or 5 sprints. That's it.
How long is a sprint for you guys? Sprints like that's
It's
agile
2 weeks.
terminology. So you get 2 week sprints on the technology,
Yeah,
right? That's
yeah,
impressive.
yeah.
That's a fast turnaround. And
Right.
one of the things you said here, I'd like to dig into a little bit, which is like you're talking about the value add. How do you think about quantifying that? Because that's one of the things where I feel like often organizations just customers want X, let's deliver X, and the quantification of the value it provides to the consumer, and frankly, how that flows to the top and or bottom line of the institution is the part of the puzzle that often gets missed. So I'm curious how you guys think about really quantifying the value being added by a new feature, a new capability. Because I think it's hard to do, but it's crucial if you're really going to prioritize. You have to know what it's worth and how you think about measuring what it's worth.
Okay, so I'm going to say something that may be a little surprising to some, maybe not to some others, but it's not a new idea.
I love
This is
surprises.
it. This is it. So I would ask you to care more about what the consumer wants than staying up with the Joneses. Meaning a lot of different companies look at what others are doing and say, hey, they're successful. They have these. If we get that, that's not true. Spend more time focused on your consumer, what your consumer needs, right? The demographics may be different. It's not even one to one. So what's the majority of your consumers need? And always go back. We're constantly going back to our consumers and learning from them. That's why we value complaints so much.
Yeah.
We take those very seriously. Even the small ones, we record the small ones. Well, I didn't like this so much, but no, hold on. Let me dig into that, right? So that's little gold nuggets for us.
I love that, and it's going back to your consumer. I think it's maybe trite in Silicon Valley, but it's so hard to do because you see your competitor go out and they release some feature, and you go, should we have that feature? Do we need to build that? Oh my God, we're behind. And of course, you never
Yeah.
know. Their product manager maybe sitting there go, I launched this feature, nobody's freaking using it, and we spent 3 years building it, and now it's a total time suck, and people don't even like it. You don't know that all. It's so easy to get caught up in what is going in the market, what got the press, right? American Banker wrote an article about the amazing thing that this guy did, and like, it doesn't
Yep.
mean it's actually providing value. And keeping your focus
100%.
on what does my consumer want, what do they value, and there's also always what they say they want, and then what they actually use when given, and they're not always the same. So that kind of
Correct.
focus on that, what's providing value, I think it's so easy to say and so hard to execute on because it's easy to get caught up with the shiny stuff and the thing that the CEO wants or that's the shiny object in the industry or the whatever. And I think
It goes against the grain of human nature. It is absolutely human nature to stay up with the Joneses. I mean, look, you see someone buy a new car on your block, just look 6 months later, there's 5 of them on your block, right? And it's just human nature. So what we're asking you is to fight human nature and really create a culture with your consumer to say, hey, I'm going to have multiple touch points with you. And this is not going to be just a one-way relationship. This is going to be bilateral. And I'm going to solicit your feedback quite a bit, actually, because I care that much too. And if you don't answer this time, that's fine. But if you answer 4 or 5 times or 2 out of times, that's great.
yeah.
But I'm getting it.
Well, and I love your point about using complaints as a source of feedback because they're not, in some ways, they're more valuable because there's this natural inclination, there's a self-selection in who agrees to answer a survey or provide feedback. But when somebody's coming and saying, I'm not happy, like that's a great learning point, and it tells you a lot. And it's easy to think of that as a compliance thing or a regulatory thing or a brand thing, but thinking of it as feedback about the product and the experience that you can take into your development lifecycle, I think is extremely valuable. And it's easy for product team to ignore that. It's like, yeah, we gotta answer the regulators about the complaints we got and what are our complaint levels and are we okay with them. But like that's such useful feedback, and it's not the people. There's obviously self-selection in who complains too, but I think it's a kind of unfiltered version of what people really think about you. That's incredibly valuable because it's it's not a hey, I'm putting on my advise the bank hat. It's just like I was trying to do something and it didn't work, and like what the heck. And that's a great set of feedback.
Yeah, and there is a little bit of humility to it, right? Because you may build something, you have to check your pride at the door and say, look, just because one consumer said something doesn't make what you built wrong, but it can make it better, right? And you got to be willing to change it because when you toil over something, you build something, right? You get this pride about it,
Yeah.
and especially if it's been successful, right? And so what you'll hear is all these little complaints, and you'll tend to shuffle. I'm asking you not to shuffle them away. I'm asking you to actually gather them and say, hey, tell me more, right? And let's go deeper. What do you exactly mean on this?
It takes a lot of humility to do that. And then you got to, of course, not every consumer complaint is accurate. Like you sometimes go,
No.
That's fine. Like I'm willing to live with that misconception, that problem, that friction, that whatever it was. But being able to kind of, it's kind of once you got to read it, then you got to sleep on it overnight. You can't like react in the moment. You go, that's just crazy. This people just doesn't. But you got to
But even the
tell you
ridiculous
something.
ones, where it's completely their fault, I go back and say, what can I do to make it easier for
Yep.
that person to get to the information, right?
Mm-hmm.
Or to do what they wanted to do. How I make it more prevalent, right? All of these things are very creative and
Yep.
but it really it tells you care about the consumer, and that's how you build this empire that delivers a lot of value.
Mm.
It's in chips, and then when you chip it all away, you have a statue.
Love it. All right. Well, is there anything you wanted to, I've got kind of three questions I always use to end the podcast, but I'm curious if there's anything you wanted to talk about or expected to talk about that we missed before we get to those.
No, I think you did a great job. Thank you.
I think you did a great job. I just asked the questions. You got to give the answers. That's the harder part, Anthony. Well, so here's my three kind of rapid fire questions to end the discussion.
Okay.
Number one, what's the best piece of career advice you've ever gotten?
It's a two-parter. So number one, think of yourself less and others more.
Okay. Like it.
And number two, in leadership, you serve them, they don't serve you.
I like that. When I was at IBM, I got something I can't, not work safe, but they said you can either be a funnel or an umbrella for stuff that comes from above for your team, right? You can either funnel it down and stamp harder, or you can shield them from what's above. And I feel like if you can be an umbrella instead of a funnel, you've done some good, right? You're there to serve that team, not to be the the voice of above coming down. So I like that one.
Yeah.
All right, second question. What's the best advice about the consumer lending space you've ever gotten?
Ooh, this is very, very wide brush, but
It gives you lots of room to maneuver to where you want,
um,
or just a good piece of advice.
okay.
All right.
The best piece of advice I got was do not be afraid of looking at the ridiculous when building products. Meaning,
The ridiculous.
like I remember, yeah, ridiculous. So I remember way back when I started auto finance, like people looked at 72 months as, oh, that's ridiculous. You're gonna hurt the consumer and things of this nature. And don't do that. And then 84 months came around. And that was now 84 months is the new 72 months, right? And people are looking at 96 months and longer and for vehicles, and there's reasons for that we can go into. But there are certain aspects of your business that are kind of hard coded in there. Look at the root of that hard code and say, is that a good hard code, or is that a bad hard code? Like, can I change that hard code and actually go look at this rather than have this preconceived notion? Let's go explore it. Let's go explore the ridiculous.
Explore the ridiculous. That's great. That's great advice. I like it. See, you found good stuff. Last question. What's one bold prediction for the future? We've already talked about like Bitcoin and EVs taking over the world. So maybe you've already tread this ground, but one bold prediction for the future.
I think we're going to see a rapid conglomeration of both lending institutions and dealerships within the next 10 to 15 years. You're going to have less mom and pops, and you're going to have a lot more mid-sized to large companies.
All right. Conglomeration of dealers and lenders. That's
Yep,
a bold prediction. I like it. You've answered them all.
it is.
Anthony, I appreciate the time. This was a really fascinating conversation. I appreciate your making time to have it with us.
It was my pleasure. Hey, have a great day.
You too.
Bye now.